Good afternoon, everyone. Welcome to Trader Merlin. It is your Tuesday Trivia Taco edition. Hope you had a great day out there. Yesterday's show, I got a lot of questions that dealt with psychology and people sending in their trading plans to me and just asking for advice. So just understand this first off. This show is not meant to be financial advice, right? This show is me sharing my experiences with you, not financial advice. And I am one of those people that believes that everybody can succeed as a trader. I think that the work that the turtles did, so if you want to look it up, just type in the turtle traders, kind of proved you could take anybody off the street, as long as they followed a very specific set of rules, could demonstrate success in the financial markets. I'm a firm believer of that. Of course, having dealt with the FTC and other regulatory bodies, you know, they don't want those kind of statements that anybody can do this. I do firmly believe that anybody can do it. However, it does bring into question, is it for everybody? And at what point do you need to throw in the towel? And it was a great question that came in from Erica. So I decided I'm going to start this show off with Erica's question. We'll dive through this a little bit. I'll give you my 2 cents on what I think it's going to help fix Erica's problem, and then we'll dive into the markets, etc. So here's the question that came in from Erica. She says, thank you for yesterday's show. I too am hurting. I've been trading for about a year now, and I have struggled. I want to make it, but I get the feeling that trading is not for me. Should I keep trying or quit? You know, that's a tough one. So I started the topic for today's show. It says, at what point should someone admit trading isn't for them? And again, I am a firm believer that anybody can become a trader, but it's a process. And I think that the industry has this way of making you feel like it's going to be something that just happens immediately. And you take one class or you watch a YouTube video from somebody who has no proven track record whatsoever, and all of a sudden you're going to be making millions of dollars a week. That's not the way it works, right? There's a process to it. So what I thought I would do for you, Erica, you sent this in, but you didn't give me any details whatsoever. I hope that you're watching. If you do, interact with the audience here. But I don't know what markets you're trading. I don't know what contracts or share size you're trading. I don't know how big your account is, what your biggest drawdown is. Where are you making your mistakes? So let me go through what I call the process. And I just threw this together, like a half hour ago, just because I've just been slammed today. The process, I think, is going to be applicable for all of you. And as I go through this, for those of you out there, if you want to add something to this, let me know. I'm more than happy, but maybe want to wait till I get through all. I think I have 7 points here. So for Eric and anybody else, this is kind of what I think the process of becoming a trader is. Number one is you got to define your strategy. This may be one of the hardest things that you're going to do because there is a million different strategies out there. When I was in college, I went to not a great school, from alma mater, Sonoma State University, but it was close to my home, got my finance degree. We had some pretty crappy professors, I will say. And one of the professors, basically what he said is, two things. Number one was, whatever your last name starts with, those are the stocks that you can pick to invest in for the semester. So I was stuck with R stocks, not a lot of big names in the R space back in the 90s. He also says, I want you to pick a technical indicator and do a report on it and present it to class. Look, there are hundreds and hundreds and hundreds, if not thousands of technical indicators, all of which are derived from historical price, but people believe that that is a strategy. No, it's not. It's just a way to read price. So I would argue that you need to find a strategy. I am a practitioner for my own trading and investing, both short and long term. I believe supply and demand is the fundamental driver of price in everything in markets. So for that, I would say my strategy is supply and demand. And also, for those that know me well, behavioral analysis. I'm a huge believer that there's psychology behind these trades and the way that you and I think about when we buy, when we sell, the emotions that we carry with us on every trade. So first would be define your strategy. And I'm not here to push any strategy on any of you. There are proven stories. Guten Abend, Joe. There are proven stories of people that use like tarot cards and constellations and migration patterns of elephants, and they make money as traders. Now, hear me out. I personally don't think the migration patterns of elephants are going to help you make a better trade, but I think it is all about having rules around your trade. On yesterday's show, I already forgot the gentleman's name. We had a gentleman who was struggling on a specific trade because he's buying hymns as it's falling apart. You want to go with the trend. Go with that trend, right? Those are simple, basic rules. And when I was in Italy, I actually wrote a paper and we pitched it to the European Union, and we want to do a study with government funds, of course. I could have done it with my own money, but why not get some government money, where we were asking for 50,000 euros, and the whole portfolio was going to be literally flipping a coin. So here is the strategy. Hear me out, folks. You guys tell me whether you think this would have a probability of success long term. Let me finish the strategy. My strategy for this European project was we would throw a dart at a newspaper, and whatever stock it hit, that's the stock that we would trade. Then we'd flip a coin, and we'd flip that coin. Heads would be going long, tails would be going short. Okay, so there we go. That's the basis. Hold on, not done yet. So we throw a dart to pick it, doesn't matter what security. If it's heads, we go long, tails, we go short. Here's where the magic happens. Two things. Number one, we always have a 3-to-1 reward to risk ratio. Meaning if I'm risking $1, I'm trying to make 3, right? So we set that up from the very beginning. The second piece, which I think is even more key, is that if the stock is trending up and we hit heads, we can double our share size because we're going with the trend. If the stock is trending down and we flip heads, which is go long, we have to do half the normal size. So if you're going with the trend, you double your size. If you're going against the trend, you half your size because the risk management side of things. Now, do you think that long-term that strategy would work? If you're doubling your bets when you're going with the trend, again, it doesn't matter what security, and you're cutting your trades in half share-wise when it goes against the trend. What do you guys think? Think that would work long time and having a reward of 1 to 3, risk-reward ratio? To be determined. I haven't actually run it with real money, but I think Dan says long-term, yes. We are going to have some fluctuations. And what's nice about that strategy, it doesn't matter which direction the market's going because you're looking at that individual security and saying, if it's with the trend, I'm doubling my position. If it's going against the trend, I'm going to do half my position. Maybe at some point I'll do that. Maybe I'll just do it with my own money and just do an empirical report. One day, each day I'll do a different trade and see how it goes. Do you have to enter immediately regardless of price? Good question. We didn't have that detail covered. Do we wait for it to come to a demand zone or do you buy that day? I'm going to go as far as say we'll buy that day. So that actually would decrease our odds, right, of success. And while I want to increase the odds, I think, I don't know, I'll have to mull that one over. And this may be something that I end up doing with maybe I'll set up a $50,000 account and just do it on my own and just track it here on the show to see how that works. Because for me, that's a very basic strategy. I didn't give myself a lot of rules, right? I'm not worried about which market I'm picking because I'm throwing a dart. Not the best way to go, but that's just part of it. I'm also putting more money on the line when I'm in a trending market in my favor and going against it when it's down. Your cost average will go up higher if you double up. Exactly. So I just threw that out there for everyone. That's just a very basic strategy. Now, of course, yours might be much more complex than that. I personally think you should try to keep your strategies as simple and as minimal as possible and not convolute with too many other pieces. Now, I know many of you love different indicators. Awesome. That's great. Incorporate that into your strategy, right? So based off of that, I've given you a very simple strategy that may or may not work. I don't know. I've never tested that one myself. I do believe long-term it will work. So let's say that's our strategy. The next step is start with slow-moving markets. Now, in the example I gave you, that's not going to work because I'm throwing a dart. For new people starting out, and I think this might be the question from Erica, is you're a year into this, so you should have a good amount of experience in dealing with volatility. But most people out the gate should start with slow-moving markets. My recommendation is trade ETFs of the indexes to start. You're not going to make a killing. You're not going to make a lot of money, but you're in something that's not going to tear you apart either. We watched with HIMS the other day. I think it might be still, I saw someone say it was still falling. I mean, HIMS down another 10% today, It's going to keep going until it stops. So, this would be one where if we got a tails and said short, then we could double our position because it'd be going short. Brutal. Absolutely brutal. You wouldn't want to touch this thing. And if you see 10% days on your security starting out, move away from this, right? But if I went to SPY, there's some big days in here. I mean, if you look at this one here, I'm going all the way back to November 19th. It looks huge, this giant red candle. That's because it gapped up and sold off. But at the end of the day, that was only a decline about 1.5%. That is palatable, right? Yeah, and Dan says index ETFs and not individual biotech companies. Absolutely. Oh man, you do biotechs. I'm sorry. If you start with biotechs as a trader, you're an idiot. You're going to get lucky on one, but you're going to strike out on 30 and you're going to blow your account. Sorry. It's just the way it is. Lisa says, I would not trade 0 day to expiration options. Sure, right. Because it's got to be fast and it's definitive. So if you scroll down here for the newbies, I have these sector ETFs. I think any one of these might be okay for you to start off with and practice a strategy. Now, I agree. I don't think that you should do biotechs, which is going to be XLV, right? This is healthcare sector. Probably want to stay away from that one because that might be a little faster. But financials, technology, you got QQQs, Russell 2000, you have SPY, you have energy, industrials, the Dow. All of these are diversified enough so that you're not going to get, torn apart on a trade. So I would do it with a slow moving market to start. Number 3, trade small share size. Everybody wants to get rich real quick. And he says XLU almost 2% is rare. Getting a 2% day for XLU would be a pretty large day. And you had 1.66 today. I mean that is a rarity for that one. And here's the chart of it. And you can see it's an anomaly. There are some big days, but today is definitely a rare day for XLU. XBI, I don't trade XBI, I do XLV. XBI is the biotech ETF, correct. My only concern with this one, and I'm glad you brought this up, so part of that, start with slow moving markets. I guess we could do a subset of that. So let me go back here, and I'll make a minor addition to this table. And hold on, it's trying to find PowerPoint and do this all live is going to be a little bit tricky. So start with slow moving markets, but I also want you to filter the market. So here we are now with filter as a substack. Why did I put filter in there? Because I want to make sure that you're not trading things that are overpriced or underpriced. You want something in the sweet middle range. What you don't want to do is be trading something that has super low liquidity, no volume, or is a penny stock, or is $3,000 a share. That's a little bit cost prohibitive. So find something in that sweet spot. Right? So we filter those markets. XBI. I don't trade this one, so I don't know. I'm going to assume it's fairly liquid, but I have a rule for myself, and you can modify this however you like. That rule is anything under 1.5 million shares traded per day average, I'm not interested. So let's add volume. Today it traded 5.87 million, and that's kind of a low print, so this is totally acceptable should you want to trade an ETF for biotechs. Just understand that a biotech ETF will have more volatility than something like SPY, right? Even though this looks a lot more volatile, those percentage moves are not as big as you would see with that XBI. So thank you for bringing that XBI, Liz. That's definitely could be done. But filter. So filter for price, filter for volume, and make sure that you have enough to absorb your prices. If you're trading something that's very liquid or illiquid, let's see if BOTZ, this one's probably picked up a lot of volume. But this is an ETF for AI. This one trades less than $1 million a day, 760,000. So even though I would like to purchase this one or be involved with this one just because it deals with AI and robotics, very thinly traded. Okay, so you're starting to put yourself at risk by having something that has lower liquidity. Still, 700,000 is adequate, but I'm a little bit pickier. And I'm sorry, I don't have this chart up. There's the volume of that robotics one. This is BOTZ. Another one in that space, I think, is ARTY. Yeah, this is another AI tech fund. This one trades, 500,000-600,000 on average. That's still relatively low. Okay, yeah, I meant to be showing big up. I just didn't have it flipped over. And Andy, great point here, says, and no leverage ETFs. Absolutely. Absolutely. Stay away from anything with double or triple leverage for now, right? The key, I remember when I learned to ride a bicycle. I literally remember this vividly. I had this little two-wheel bicycle. That's what the definition of a bicycle is, Merlin. I had this little bike, but I remember it had solid rubber tires, which are pretty cool. And I used to ride that. We had a slightly sloped, walkway leading to the house. It was probably 25, maybe 30 feet from the road to the front door. And I remember I used to stand at the top of that slope and I just pick my feet up off the ground and I would just kind of coast with my feet right above the ground and use that almost like training wheels until I started getting more and more comfortable with that. What most people want to do is they want to jump into like the most high performance bike in the world and start doing wheelies down the street. Like you got to learn how to ride that bike first. So start with something that's slow, doesn't move very quickly. If you plan on making a lot of money very quick, do whatever the hell you want to do. If you want to survive at this for the next 10, 15, 20, 30 years, the rest of your lifetime, then start like I'm showing you right here. This is the process for success over time. So we've got your strategy. Again, whatever strategy that is, I don't care. We'll modify it later on. Once you pick your market, or pick slow moving markets, could be stocks, could be futures, right? Then you want to trade either small share size or small contract size. I encourage people, and this flies in the face of what Larry Jacobson teaches, as well as Trading Academy. I definitely differ in opinions here. I think Trading Academy does a good job of really trying to protect investors and make sure they don't move too fast, right? The key here is protecting your assets. So Trading Academy's approach is start off in a simulator till you get comfortable with it. It's training wheels to your bicycle. And while I agree with it to a point, I think if you are in a simulator, you have no emotional attachment. You don't have that emotional fear, that the euphoria, the sweaty palms, the nervousness, the second guessing, the patting yourself on the back stuff. You don't get that when you're in a simulator. You can just turn it off and all goes away. So I would say to start, trade small share size. And that doesn't mean 1,000 shares, right? Trade one share. Literally trade one share. If you're like, well, Merlin, I don't want to take much risk, then fine. Go SPY. You're going to trade one share of SPY that's traded at $692. So that's $692 you're going to put on the line. Are you risking it all? No. There's no way this is going to zero tomorrow or the next day or the next day or the next day. This will most likely never go to zero. Could you lose $5-10? Yeah. Look, if you held SPY overnight and had one share, you lost $1.83 total. That's your net loss today. Big deal. But you start to get a feel for how these things move. You get comfortable with them. You can always add shares to it to increase your risk. My mentor early on, Fernando, he was adamant about this. He says the single greatest way to control your risk is share size. And, I think I've told you the story, which I've said many times, but Fernando always told me, trade one share, and as you get better, add 2 or 3. He said, never trade 1,000 shares. Mind you, when I learned how to trade, the original Online Trading Academy was a high-speed day trading shop. That's what we did. So I was told, do not trade 1,000 shares out the door from class, right? I'm like, yes, sir, yes, sir, yes, sir. And as soon as I sat in front of that computer, the first thing I did was trade 1,000 shares. The first trade I made out of my class on that trading floor was 1,000 shares of Netscape, the most volatile stock of the day. Greed kicked in, my own attitude, my ego kicked in, and, well, that's the story for the book. We'll have to wait and see. So I definitely think you should start small, 1 or 2 shares, and just slowly build up. Number 3 on this list, I don't even remember what I put on the list. PBJ says, use Sim to master the platform, then small shares. Says, yes, especially if you're using a complex platform like Thinkorswim, right? Thinkorswim or TradeStation, at least the old version of TradeStation. There's so many bells and whistles, it's too much. Even Click, the program that we're building at Trading Academy, has some bells and whistles that I think should be truncated down. Like, I wish there was a little switch. You could click it and go super basic mode or advanced mode, kind of like crypto platforms do. But yeah, to get used to the platform, Simulator is great for that. But it does not replicate the emotions of a trade. And it can also allow trades to happen that aren't real. That's another really, 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 really important piece. Yeah, I see you guys saying I'm a buyer at $1. You and me both, Steve. I would load the boat with everything I had at $1. We all know mathematically it's not possible for the S&P to go to zero. That means the entire financial system of the United States and many international companies would literally go bankrupt. If that happened, we probably are experiencing a catastrophic terraforming event that has destroyed the planet. So yeah, S&P is not going to $1. Never going to happen. Number 4, execute the strategy. So we've defined what we're going to do. We know our rules. And I think for Erica and others, The importance of the rules are, this is your Bible. This is how you live your trading life. This is how you're going to push that trade and hit those buttons. There is no ambiguity here. You're saying, if this happens, I'm going to do this. If that happens, I'm going to do that. There should be no confusion at any moment in time if you should get out of the position, stay in the position, adjust. All that should be mapped out in your strategy, right? So you don't have any problems there. You figure out what market to trade, something slow. Use a filter if you have to get rid of the garbage. Trade small share size, and now you execute. So this right here, those 4 pieces, while there is more complexity to it, I think you would all agree, this is the foundation of what it takes to be a successful trader. But you're not done, because the strategy that you have implemented, or even the market that you may be trading in, may not be right for you. So what do? You review the results. You go back through and you analyze. And yes, I did see your email did come through about the, what was it? Lisa sent in an email about using AI to evaluate her trades. And I have not done a follow-up show on that one, but it was awesome. I will say it was actually very, very cool the way that AI broke down what was working, what didn't. And it was very explicit. It said, don't do this strategy anymore because this didn't work for you. Focus on the other stuff, right? It was really cool. I have not had the time, Lisa, but I wanted to build out some models and throw it through AI because I don't want to use your slides and your materials. I don't want to, that's your private stuff. But I wanted to show, here's how you can get this to bust out the results. It was spot on. In looking through the trades, it was totally spot on. And that certainly can be a piece for you to run through here. And the AI will tell you, you're probably on your losses, you traded too big a share size, or different pieces will critique you. Review those results. There is nobody, not one single person on earth that has the perfect plan that executes perfectly every single time. It will modify, it will change, it will morph. So you have to constantly be reviewing these. The question would be, how often do you review your results and modify your strategies? So, Tilly Allison, who I'm happy to say I believe is going to be coming back to Trading Academy. I'm excited for that because she is awesome, and maybe I can get her back on the show. Just love old Tilly. She would do annual reviews in the long-term investing accounts. But some people do it once a month, right? And reevaluate or rebalance a portfolio once a month. I think that's probably a good starting point for everybody here, is to go and look at once a month. Let me take my trades for the month. You can download the Excel spreadsheet from your broker and dump that into an AI like ChatGPT or Grok and say, hey, analyze my trades and be very thorough. Tell me what I'm doing right, what I'm doing wrong. What do I trade best? All that stuff I used to do manually. All of it. And now AI can just spit out in seconds a very thorough breakdown. Yeah, it was really, for Lisa's, it was pretty awesome. I could just imagine being a fly on the wall at Lisa's house when the result was spit out. I bet you were just like, this is incredible, right? You were probably grinning ear to ear because it did give you very extremely positive feedback. It was encouraging because she was actually having some phenomenal trades, some very good success. And unfortunately, when she switched up her strategy and went with a different strategy, it kicked her in the butt. And AI was very happy to point that out, which you needed to hear, right? It was awesome. Really cool. So AI can help you review those results. And Erica, who started this discussion by sending in that question, if you're really struggling right now, ask AI. I'm not saying it's the holy grail, but it can certainly help identify why your strategy may not be working. And I don't know the extent to which how in-depth the analysis will be, but review those results. Number 6, you make those adjustments. So once you find out what you're doing wrong, or at least you'll never know 100% what you're doing wrong, but you can find the big chunks. So you violated stop losses, or you traded too big a share size. You're over there trading hymns against the trend. Let's not do that. You make adjustments. Now, here's where it gets a little tricky. I'm a believer that, and this is going to fly in the face of what AI will tell you, I'm a believer that, let's say you do your review process, you review your results, and it comes up with like 5 different things that are problematic. I would look at those 5 items and say, which one do I think is going to be the most impactful? And I would change one thing to my strategy. I wouldn't go and change all 5. And the reason for that is, and this is just me, I'm a weirdo, I can't quantify which one of those 5 pieces had the biggest impact in that adjustment. So if I just change one of those 5 pieces, I can now see the results, see its impact, and then I can do another review, and now maybe my review only has 4 pieces, and then I'll modify. I think if you change all 5 at once, you could get drastically different results, which may be good, may be bad. But how do you attribute the changes to each specific factor that you've changed, right? So I almost sound hypocritical here because of my own personal journey through fitness and health and nutrition. I made probably 40 changes to my life all at once. And it's worked because medically I know the science behind it, and I'm pretty sure it was good. When you are trading, though, do not make more than one significant change at a time, right? Start with one change, track, and review. So once you do that, step number 7 is easy. You make those adjustments, and then you go back to step 4, which is execute that new strategy, review the results. I would say do it monthly, then make adjustments. And this process right here, steps 4 through 7, will be repeated until the day that you say, I can't trade anymore physically. Maybe mental clarity is not there or whatever. But you can take that to the grave with you, continually just going and repeating those processes. So if you have pieces to add to it, I'm happy to modify this. This is something that's just off the top of my head. I just sit back after I read her question and really go, what in my experience were the biggest factors in pointing me in the right direction and getting me to that goal and objective that I've been striving for. And I would say that this is it. Number 1, define your strategy. Number 2, start with slow moving markets and make sure that you filter out those markets. Start with small share size and then execute steps 1 through 3, right? Put them all into practice. I think you do it live with real money, but if you want to do it in a simulator, that's okay as well. Review your results, make adjustments, and to do the whole process over and over and over and over and over again. So I hope that helps you, Erica. I don't know with what areas you are struggling. My guess is you are making one of several mistakes. You might be strategy jumping, which is you're moving from one trading idea to another. You may not even have a strategy, which is probably the worst thing that you can do. I hate to say that. A lot of people will just follow Jim Cramer's advice, or I saw some podcaster talked about this one. As amazing as Colin Teddards is, which I love Colin. He's fantastic at fundamental analysis. Remember, fundamental analysis is usually a much longer term to come to fruition type of trading style. It's more position trading. So you might be following Colin Teddards, but being a trader and be like, well, I'm losing money because of him. No, you're not. You're losing money because you're not following the 1 to 2 year cycle. You're trying to day trade his stuff. So make sure your strategy fits who you are as well. Whether you're a day trader, a swing trader, a position trader, all that is extremely, extremely important. So I hope that helped. Dan says the hardest part is step 1. I would agree, which is why I'm a huge believer of simplicity. There are some very complicated strategies out there. Personally, I think that people make their strategies very complicated so that you believe that this is a complicated business and you have to buy their strategy. I think when you just go in simple supply and demand methodology, it's much easier. And he says for options, spread trade may be easier. It might be, but again, the complexity of setting up spreads and what kind of spreads will confuse most people. Will confuse most people out there. Most that are starting out, they struggle with going long and then going short, right, Andy? Going long and going short. Most people still don't even short the market. They don't know what shorting is. Like, what? It's like buying a car that doesn't have reverse. So you got to be able to go both directions if you are looking at being a trader. Got to go long, got to go short. Okay, so that was my long-winded answer to Erica's question. I hope that some of you found that useful. Some of you might be struggling as well, and it's okay. Everyone's going to struggle at certain points. The key is to try to identify, what is causing your struggles and make a process out of fixing it. Now, the question, the clickbait here was, at what point should I admit trading isn't for you? Well, Erica, I don't know the situation that you're in and why it's caused you to experience a lack of success. What I just went through, in my opinion, would be the factors that are going to help you succeed. Here's when you should hang it up and stop trading altogether and move into a different career. And I don't have anything written down for this, so I'll just go off the top of my head. Number 1, if you're someone who is so stubborn, and I would say almost even arrogant, and you say, I can do this, I'm better, I don't need to follow other people's, historical precedent, walk away, because the market will just destroy you. Number 2, if you aren't willing to admit that you are wrong at any point, stop trading. So this goes to people who are alphas, who have big egos and can't admit they're wrong. Look, I like being wrong. It sounds weird to say it, but I'm so comfortable with it. I'm wrong all the time. I like being wrong because when I'm wrong, I identify it, I take a small loss, I learn from it, I move on and make a better trade next time. That's okay. Because when I'm right, I have much better success. So admit that you're going to be wrong. The third part would be that you're willing to be humble enough to admit that you're wrong and make changes as needed, right? It's kind of like I'm reading or watching a very interesting podcast. So I've always had sleep issues, always. And there's 4 main chronotypes that we all have. Every single one of you has a built-in chronotype in your body that defines your sleep patterns. There's the bear, there's the wolf, there's the lion, and there's the dolphin. And I'm watching a very interesting podcast on this. You guys might have, I forget the gentleman's name, but it's called Diary of a CEO. And it's one of his new podcasts, came out yesterday or day before. It's 2.5 hours. But the reason I bring that up is you might think that you have a sleep pattern it's just the way that you sleep. The truth is, as we progress over time, our sleep patterns change. When you're young, you're usually awake early and you go to bed early. And depending on where you are in your middle life, you might go to bed. I hate waking up, but you stay up late. And as you get older, your melatonin sometimes starts to produce earlier, so you're going to go to sleep earlier. If my sleep patterns change, then I think my trading patterns are going to change as well, and my reaction to data. So just understand that we are all constantly changing, whether that's my trading behavior, my sleep behavior, my work behavior. There's changes that happen. And if you aren't willing to admit that and willing to adapt to changes, then walk away, because the markets will change all the time. Right? We're now still in a bullish phase, but as we pointed out here, it feels like it's slowing down a little bit. Nothing dramatic, but notice we've gone from back here in May, June, July from roaring bull market to now. I could put a little yellow box. Here comes the yellow box. Here it comes. Look at the range we're stuck in right now on the S&P. I mean, for all intents and purposes, we've been stuck here since December 16th, and we're near the higher end. I do kind of think that we're going to go to all-time highs, but the I knew you were going to show up there, Ollie. The truth of the matter is, it has slowed down, right? It is not saying it's the end, but we've slowed down. So we have to adapt to a different market behavior. This is channeling now. Obviously, we're near the upper end of it, which is great, and there is a higher probability we're going to break to the upside here because the trend is up, but the market has been for 2 months chopping sideways. So we have to adapt to that and no longer go heavy long trades. Maybe I start doing more spread trades here if we're stuck in this range. So that's when I think you should just admit trading isn't for you. One major part of this is trading will humble you very quickly. And if you're not someone who's humble, if you're an arrogant, loudmouth, brash individual, then you're probably going to end up failing at trading. Sorry. I think it's just math. I think there's a lot of people that I see in this industry who are overly loud, overly flamboyant, overly boisterous, and I'm willing to bet you that if you pulled back the curtain on those people, they were losing money. They're probably net losers. But because they have such popularity, they make money off of guest appearances and their podcast or their shows on CNBC or Fox. That's where they're making their money, not actually as traders. So Les says the iron condor. Yep, iron condor. Or the iron butterfly. I always like the iron, just the name, the iron butterfly. Reminds me of the 1960s. Well, not that I was around back then. Anyway, all right, that'll do it for my topic du jour, which is at what point should someone admit trading isn't for you and isn't for them. Thank you, Erica, for this. I hope it helps. I can't tell you whether to walk away or not. If you gave me more information, I might be able to kind of pinpoint what the areas are that are problematic to you. But I'm hoping you all understand that I've got 50,000 things going on a regular basis here. So it does take me time to get back to emails, and I'm trying to be faster and better at it. But there we go. If you have any other questions on it, let me know. Let me know what you guys are thinking. Soda waters, man. It's a big change. Okay. Now, let's go into current market data. I don't know if you guys saw the retail sales numbers today. Did not like that. We were expecting it to come out at 0.4. It came out at 0. That's not good. Here we go with your economic data. And if you guys have, there you go, Inagata Davida, you know that one. Here is the retail sales chart, which doesn't look bad there. But when I zoom past all the data there, boom. You see the little dash mark. I don't know what color it is. I guess that's green. I always thought it was gold. The green dash mark was 0.4. We came out at 0. Look, that just means we didn't get an increase in retail sales, which is okay. It's not the end of the world, but it's not great. You kind of want to have that residual, spending. The more that retail sales go up, the better it is for the economy. Now, that said, Ken says, Erica, good luck and do not pressure yourself. Agreed. I'm hoping I wasn't too tough love or too rude about it. I still think you can do it, Erica, but you've got to dig deep. You got to do a lot of interpersonal reflection here, not just on your trades, but how are you handling it? How are you responding to these losses? How do you deal with them? Those are all really important pieces as well. So let me know how it goes. So we have this retail sales number tomorrow. I'm curious what you guys think. We had the retail sales today. Tomorrow is a very important day. As you guys can see here, the expectations are that retail sales are going to stay at 4.4%, unemployment rate stay at 4.4%. So I'm going to throw a poll up here for you. Just curious what you guys think the unemployment rate will be. Right now we are at 4.4%. Expectations are that we're going to stay at 4.4%. I did drop it. So I put 4.3, 4.4, 4.5, 4.6 as far as unemployment rate. So I'm curious what you guys think here. You guys let me know. Go ahead and click on that poll. It's in the chat. I know, we got a bunch of people in here. A lot of people. I should see a lot of votes on this. And I'll tell you in just a second on what my number is. While we do that, let me just go back here and I'll start setting the stage for the justification for my number. I'm going to go back to last week. All right, so we'll go back to last week, and I'm going to sort this and filter just for U.S. markets. So with Forex Factory, you can remove every other market. I'm going to take out the speeches and business surveys, and we're just going to click on Apply Filter. So last week, this one was the most important piece. It's the ADP non-farm employment change. If you notice the trend here, this is really ugly. This is real ugly. I mean, the trend has been just down since 2021, and we're basically teetering above and below zero, which we have tipped below a few times here on ADP non-farm employment change. Now, the previous number, you can see we came out at 22,000. The expectations were we're going to have 46,000 new jobs. We only had 22,000 new jobs. And that trend is continuing to go lower. That's data point number one. You had unemployment claims. Unemployment claims surged last week. We went from 208,000 up to 231. That's not good. And then you had the JOLTS job openings, which is supposed to indicate what does the workplace look like? Are we getting more job openings in the U.S.? And look at the trend right here. We're seeing a steady decline. This is going back into 2018, but we peaked in 2022 at about, over 11 million, probably 11.5 million. And now we're sitting at 6.54. We were expected to come out at 7.25. So really what we're getting is a lot of really bad jobs data. And for me, I'm looking at AI certainly as a factor, but not really that significant now. More likely in 6 months to a year, we'll see AI more. I'm in the camp of 4.5%. Well, I'm going to end this poll here to see what you guys says. What is driving it, Brush Buddy? Several different things. I think that businesses right now are feeling the pinch of a potential market slowdown, so they start doing more layoffs, right? We've heard a bunch of layoffs happening over the past few months. And typically that's a sign of a market top. Sorry, Ollie, it's fact, right? When you see companies going through and saying, who don't we need anymore? That means that they're concerned that the next quarter or couple quarters could start to slow down. As Steve says here, economic uncertainty, absolutely. So as a business owner, you're going through and you're saying, okay, you're going to each department manager. I've had this happen a couple times where the department manager literally is looking at everybody's job and saying, who's carrying their weight and bringing value? And if you're not, well, you're in the next round of layoffs. And the low-lying fruit, in my opinion, is going to be any job that I can replace with AI. If I can take ChatGPT and get rid of my copywriter, my editor, my press release person, all that, I'm doing it. Done. Bye-bye. And I think you'll see some jobs just disappear because of AI, but also companies in general saying, hey, we're not as rosy as we were. I mean, economically, I think the data is still fine, but I think it's just an indication that the expectation over the next year is maybe things slowing down a little bit. So you start to get rid of employees. So let me do the results of the poll here. End of the poll. Only 32 of you. Come on. You can do better than that. I'll give you guys a couple more seconds. Come on. If you have not clicked on the poll, just do it. No new ones. All right, fine. I'll end the poll. Neener. All right, poll ended. So out of the 32 of you that responded, will tomorrow's unemployment number be? The number one is 4.6. So that would show, if we came out at 4.6, you got to understand, market would not like that at all. Let's go to the unemployment number for this week, and I'll bring up that chart. Bam. So the majority of you saying it's going to be, majority of you saying it's going to be 4.6%. Now that wouldn't be, anything astronomical. What it would be is a jump back up to where we were at the previous reading. So the month of December, we had a 4.6 unemployment rate, and it dropped from 4.6 to 4.4. I'm in the 4.5 camp. I think we're going to slightly tick up here. And, I could be totally wrong, but if every other piece of jobs data is looking not so good, I don't see why this wouldn't impact the unemployment rate. So I definitely think 4.5, possibly 4.6, but I think 4.5 is where we're at. Remember, the Federal Reserve has a dual mandate. That mandate is full employment and stable pricing. So inflation's got to be under control, which we so far have now, and jobs ticking up ever so slightly. So it'll be interesting to see what happens tomorrow. If the unemployment rate does come out at 4.6, then of course the FOMC and Jerome Powell are going to have a bigger problem on their hand because they've already cut rates 3 times, which to me, in my opinion, is going to start acting as act as a catalyst for more inflation. But here is your Fed funds futures. Now, right now, there is a 20% chance we get a rate cut at that March meeting. So March 18th is that next meeting. If the unemployment rate starts to tick up to 4.5 or 4.6, I expect to see this tower at 80%, meaning stay the same. I expect to see that shift. No, it wouldn't be an emergency cut, Andres. It's not that dire. Now, if unemployment rate, and this is not going to happen, but let's just say hypothetically, unemployment rate comes out like 5.1 or 5.2, like way higher, then yes, they could do an emergency cut, but I don't think they will. Remember, we still have to let those 3 rate cuts digest in the economy first. Those take, I've been told, 9 months to 18 months to digest fully into the bottom line financials. So we're a long ways from that happening. Dan says 5.6%, that probably would be an emergency cut. I think I think we'd have to look at that and go, did we miscalculate here? All right, 5.6, but that's not going to happen. That's just way too much. Well, the unemployment will put an end to inflation. Yeah, that's true. Steve said, I did see Trump say Dow will be at 100K by the end of this term. Hey, you know what? I hope he's right. I mean, look, I guess I should do another poll for that one, but let's just go look at the Dow and see what is the realistic probability of that happening, right? So let's just go look historically. I'm going to put this on a monthly time frame just so we can kind of look at big picture because, the end of his term is what? December of 2020. What year are we in? End of December 2029, right? That would be 4 years. Right, he took office in 2025, January. Was that 2025 he took office? I'm lost. I can't remember. I think it was 2025. I don't think it was 2024. But anyway, 2020. So he took office in 2024? Wow. Jeez Louise. So he would be out of office in, let's say, December of 2028. So let's put a vertical line right there. Thank you, guys. Wait, hold on. Now I'm confused. Big Eb says he took office in 2025, which is what I thought. But if people are saying he's out in 2028, that's only 3 years. Okay. So then he'd be out in 2029. So he took, that's when he took office, but he won the election. So it'd be December of 2024. Is when he won the election. Okay. So let's go and make that a 4-year thing. Bam. So if he won the election in December, he took office in January 2025. That means he's out of office in January 2029. There we go. Want to get those numbers right? It's important. So, okay. From a return perspective, from where we are right now, here's your Dow Jones sitting at 50,188, and old President Trumpo says he's going to get that up to 100,000, huh? Hey, I would love to see that happen, but that means we'd have to see a rate of return of roughly, well, it's a 99% rate of return in the next 3 years, 35 months. I'm going to go out and echo Dan's comment here. No way. No way. I don't know what it would take for that to happen. I don't think it would be good. Because remember, for it to rally that much, that means the share price of those companies would have to rally that much. And the only way I could see those share prices rallying is one of twofold. Number one, profits are so unbelievably good for these companies that everyone's trying to buy those shares. That's probably what I think would happen. And the other one, I think that's pretty much the only reason, will be that profits are so unbelievably good, which would be great, and AI would probably be a big factor in that, right? If AI does take over and these companies become much more efficient because of it, we're also going to see unemployment surge. And that I don't know how that's going to impact, right? Because at a certain point, the profits for companies will be amazing because they're removing all the employees, but now you have employees that aren't buying goods and services. When does that catch up with it, right? If we own the moon and incorporate, well, hey, I'd love to see that, but that's gonna be 10 years out. So as much as President Trump thinks he's gonna get there, I doubt that's gonna happen. You know, especially when you look at the long-term chart here. Just look at the magnitude that would be needed to get there. Not gonna happen. I think this is logarithmic. Oh, that's regular. Okay, yeah, I don't see that happening. But if you looked at, okay, let's just say we continued on the trend from where it's at, right? And I don't think that that's gonna be the case, but let's just move this trend line to follow. And you guys can see what I'm doing here. I'm trying to just go with the current trend of the equity markets have been in a pretty nice linear path. Well, that does put the Dow at 74,000. Yeah. Okay. I'm not saying that's out of line, although I do think it'd be pretty improbable to continue that angle slope here for the Dow. But hey, stranger things have happened, and as I've said, the trend is your friend till the bend at the end. So stay long until we see this market break out of its channel. And probability tells me, at least for the S&P, let's go back here and go to a daily. Probability tells me that we're going to stay in this channel and most likely break to the upside. Come on, there we go. So there you go. No, his term started January. Right, it was January of this. He won the election, but his term started in January of 2025. Therefore, I have him leaving in January of 2029, which is the vertical line that I had drawn on here on a monthly basis. But I don't think we'll get there. It's nice. It's one thing to make lofty claims like that, but that one I think is just out of the ordinary. You know, that's just too much. That's only 17% return annually to get up there. We'll see. Comment from Big Ev. That's good. Maybe he leaves in 2029. That's right. We'll get him into the third term. Let's just change the Constitution and get that third term in there. All right. I'm going to shift here. I'm going to try to do a topic tomorrow from Neo, and we'll see if I can do it. So I'm not doing a webinar tomorrow. I will be doing the show for you guys. So I will be here Wednesday. I will be here Thursday with John O'Donnell. I will not be here Friday. And then I'm going to be doing my webinar for Tradier next Wednesday. So next Wednesday I won't be here. So woo! I'll be here tomorrow. The question from Neo I think is a pretty good one. I'm gonna try my best. Let's hope I can get it done tomorrow. But I've got a million things going on. Today I made no trades. I've just got my regular positions, Marsha. I covered them yesterday. If you look here, great comment. It says, it's from Neo. He says, can you talk about predictive markets? What are they and how do they work? This is kind of one of the newer fad phenomenon things going on in the gambling world, in the trading world, is predictive markets. I will just say this. My belief is that predictive markets, I'm using air quotes for the podcasters, predictive markets are just essentially degenerate gamblers. All predictive markets is gambling, period. There's nothing you can do to convince me otherwise. I've gotten into arguments, so I'm blue in the face on this one. Predictive markets are gambling. However, they're now available everywhere. and they're easier than ever. I use them all the time. Like the whole Super Bowl, I'm making bets on stupid things like, oh, well, who's going to say this word first, and what color is Lady Gaga's dress going to be when they show her, and who's going to be the guest. I mean, I'm betting on everything. It's just fun and silly to do with a little bit of money, but yeah, I'll talk about predictive markets tomorrow and maybe show you some platforms just so you guys can get an idea of what it is. But again, you got to be careful with this stuff. It still, in my opinion, falls under a gray area with regards to the legal system here in the United States. So I will go into that question tomorrow. Hopefully I have a lot of time to go in depth on that one. As far as tomorrow's data, we already talked about what's happening for the U.S. markets. We have not a lot for the U.S. except that unemployment rate. So there it is. There is the unemployment rate. 4.4% is the expectation. I think we're coming out higher. You also have non-farm employment change. You have a bunch of FOMC members, which you've actually had all week. And then on the earnings front, here is the earnings for today. Pretty mixed bag. You know, these stupid ads. Go away. I find your ads offensive. It's offensive. Go away. You had Ford missed earnings big time and was up 1.7%. That's wild. CVS beat earnings and they were down. You had BP, they crushed earnings. They were down almost 6%. You had Coca-Cola beat earnings and they were down. It feels like it's the opposite bizarro world for markets, right? As soon as somebody beats earnings, they go down. That was for today. Here is what's happening for Wednesday. You have some big names out there to be sure. Cisco, McDonald's, T-Mobile. You have SoftBank, Shopify, AppLovin. I haven't looked at AppLovin lately. It did have a bit of a bounce, but AppLovin was getting absolutely decimated. Yeah, was up over 720, dropped all the way down to 360 in just the past couple of weeks. Give it about a month, that thing dropped almost 50%. Still very expensive at $472, but AppLovin reporting earnings tomorrow as well. So there is your day. Let's see. Larry M says, unless you're someone in the know, that's true. With that, it's so easy to make money if you are a political figure right now using these Kalshi and poly markets. It's wild. CME coming out with individual stock futures this summer. Talk about that someday. They already did it. Single stock futures have been around for years, and then nobody used them, and then now they're bringing it back. Let's see. I saw a post that Vegas did $130 million on Super Bowl prediction. Wow. Yeah, prediction markets are just so much easier than going to Vegas to make bets. I'm really shocked that it's as prolific as it is. And I'm going to try to set up where I can share my phone with you so I can show you what the screens look like with some of the stories I have with it. Yes, I did see the CBOE talk about predictive markets. Coinbase has predictive markets. It is the new hot buzzword because it uses a loophole, which I'll talk about on tomorrow's show. So that's going to do it for me, everybody. If you guys have something you want to discuss on tomorrow's show, let me know. Neo and Erica, thank you so much for the questions. I hope that I answer them, Erica. Let me know any feedback or details you want to add to maybe modify the response I gave you today. But I hope that helped you out. And for anybody else who might be struggling as a trader and wondering if it's for them and if they should throw in the towel, you know what? Look, that's a question ultimately you're going to have to make. But it all comes down to analysis, research, and having a plan. If you are still there, as Andy says, click that like button since I don't do enough promotion. If you are new, hit that subscribe button or like button and share the show. Let's see if we can get this viewership up to 10,000 by the end of the year. Thanks, everybody. I will see you guys tomorrow. Take care.